Everything in this video is not intended as financial investment advice and is for educational purposes only. I'm Josh Olszewicz, head of research at Valkyrie, and let's take a look at the midweek market update. Starting with the usual discussion on inflation. I'll be excited when that isn't the predominant topic. The good news is inflation, based on the government CPI prints, has gone down for 12 straight months. I don't believe that's ever happened going back the entirety of the history of that data. We continue to also see further declines in real-time estimates of inflation. This is one of them called Truflation. And the rate of change continues to be about 0.6% per month in this data set using this methodology. So in about 3 months, we may be back to 2% inflation or less, assuming the same rate of change throughout the summer. The Fed is still very adamant about being hawkish, remaining hawkish, not declaring victory. A few Fed governors suggesting further rate hikes, which I don't think would be beyond them considering they were extremely slow to the ball raising rates. It only makes sense that they would also be wrong on the other end and that they're going to keep raising us into oblivion. Now it depends on what they are looking at as far as PCE, super core, super duper core, whatever they're looking at to justify raising rates further, or unemployment. You know, they can pick and choose what they want to look at to justify what they're trying to do. So ultimately we have a data set that the regular individual looks at, but depending on what they actually want to tell you and look at, I think that's what's going to happen. So if they want to continue to be hawkish, great. The market thinks they're going to hold rates right where they're at, 5 and 5 1/4, and eventually need to cut this year. Now, there's been a lot of talk. Are we in a recession already? Will we be in a recession sometime this year? What is that recovery going to look like? Is it going to be a long recession, a deep recession? The Fed's next meeting is 6/14. The next CPI print is 6/13. Now, they've said every meeting's a live meeting. So as the data comes in, then they make their decisions. It'll be interesting if CPI is hot or cold, above expectations or below, and they pull an audible. I don't think they would, but I guess that's certainly a possibility. I'm certainly oversimplifying it by just looking at CPI, but there are lots of things that they look at, obviously. Certainly a prime component is inflation. This is the government, US government's BLS data. Looking at the breakdown, most of the declines year over year have been predominantly energy related. The sticky parts of inflation, parts that remain relatively high, are food, are services. I was surprised to see transportation services in the double digits still. Trying to justify this and think about it, if we look at this data point, which I saw yesterday, a car dealership guy, great Twitter account, puts out a lot of great data, highlights a lot of great data. This is the average age of US vehicles. So it makes sense to me if we're seeing increasingly older cars on the road, perhaps because cars are better made now, perhaps because financing a new car is extremely expensive or getting more and more expensive than ever. Maybe there's less planned obsolescence in the car market, whatever it is, that could very well be driving a higher reliance on maintenance and repair versus just buying a new car. And of course, we can't talk about CPI or government anything without talking about the debt ceiling. This was something I dug up today that Market Watch put out yesterday. Question immediately comes to mind is, when was the last debt ceiling crisis? 2011. Okay, great. And what happened to various sectors of the market around that time? Because obviously people are trying to connect it to digital assets, to Bitcoin. Based on this breakdown, it tells me that risk markets were sold off and risk off markets were relied upon, essentially. That's my read. Bitcoin has been increasingly correlating with gold rather than risk, but we are not seeing benefit to this on the Bitcoin side of things. We just had 8 days in a row of consecutive declines, which is extremely rare, has only happened 4 times since 2010. I think one other time prior to 2010. The other events where we had negative declines consecutively to this degree were related to Terra Luna stablecoin exploding last year. The other event was GOX, and then the event in 2011 was probably just nothing, not specifically, but a bear market period at that time. But we are in a rarefied air up here, being as bearish as we are day over day in a row. So that either means there is something going on, whether it's regulatory uncertainty, whether it's debt ceiling uncertainty, whether it's market makers pulling out because of regulatory uncertainty. I think collectively the uncertainty is, we're feeling it on the digital asset side of things, certainly. But moving to DXY has actually seen extreme strength last week, which only helped crush risk harder. It helped reverse gold. It helped hold the S&P steady, in my opinion. S&P down or flat, quite the nasty range here over the past month for the S&P. To me, the broader possibility, the longer term trend reversal potential is there. So long as the recent low holds, I think this is okay. The problem is, from a chart pattern perspective in the near term, is this a cup and handle? Is this a diamond top? There's conflicting stuff here going on. It just seems to me like there's a ton of uncertainty in general. But when you do get periods of low volatility over an extended period of time, the market is setting itself up for, everyone's at the racing line, getting ready for the signal. And when they see that signal, similar to the previous range here in May 2022, very tight range, likely some sort of diamond top TA pattern. But as soon as that signal hits, everyone knows where they're going. Everyone knows the direction. So once this volatility picks up again, I think it will be extreme. But right now it's just a very grindy range. And then gold just absolutely cannot break that 2050, 2080 all-time high range. I don't think that there's any specific pattern or anything in the near term, but the longer term stuff looks extremely bullish still. And the general rule is, unless we're making lower lows here, nothing's really dead yet from a bullish continuation perspective. So gold still looks okay to me, not as bullish as it did last week, certainly. And semi-related to the debt ceiling is stablecoins who hold a ton of treasuries, and they sort of have to decide, do they want long-term or short-term? At the end of the day, most of them utilize short-term because the run risk is real and they don't want to be caught holding things that they need to sell, that sort of justification. Circle has said that they've had to focus on nearer term treasuries because of default risk. Just an interesting sort of tangential adjacent stablecoin problem. But Tether continues to just crush the competition entirely, nearly back to all-time highs as far as circulating supply. They reported massive revenue for Q1. They added Bitcoin to their reserves as far as on their balance sheet. 1.5%, I believe, is the allocation. So Tether in the orange here doing extremely well. Circle, until there is clarity from a regulatory perspective in the United States, I don't think USDC starts to gain ground here from a circulating supply perspective. Another contributing factor to this decline is rates, most likely, because if rates are high, there's a risk-free way to get yield. Why bother messing around with stablecoins or DeFi, or for many people, crypto in general, if the risk-free rate is as high as it is? Assuming it stays risk-free and the government does not default, which nobody wants and nobody thinks will happen. It's never happened. Everyone is sure it won't happen, which I hope it doesn't happen. But that's one thing that would sort of turn everything on its head, is if risk-free doesn't continue to be risk-free, does money flow into crypto in that scenario? I think it would. Looking at Bitcoin on-chain activity, in the green here we have active addresses. Those are addresses that have changed in value over the previous day. And we have transaction counts. So a single address can send hundreds of transactions. And that's essentially what we've seen. We've seen a rise in transaction counts on the back of a rise in speculative NFT activity. Love it or hate it, it's allowed on the network. It does bring attention to Bitcoin. It does bring eyeballs to Bitcoin. It does bring development to Bitcoin. It does get people thinking about the future as far as what else can we do with this smart contract stuff. Not dissimilar to what happened with Ethereum when you had ICOs, DeFi, NFTs. You have all these different possibilities for eventually something interesting to fall out of that. I think right now we're very much in the highly speculative phase of this whole rigmarole. But transactions are still quite high, and they're actually still at all-time highs if we zoom way out. One of the reasons why active addresses have declined so much is because fees rose extremely quickly, and that essentially prices out a lot of people from transacting on the Bitcoin network directly. So people may see a multi-year breakdown basically of active addresses and think, well, this isn't good. But in reality, it's because fees are extremely high. Now, fees have come down. I'll get to that in a second. So fees have come down essentially back to where they were before all of the NFT minting that wanted to happen all at once. And that's the key here. We're still seeing ordinal activity. We're still seeing this NFT minting. But whenever you see fees rise extremely quickly, that's because people want priority in line. They want priority in getting their transaction across the network as quickly as they can. If there's a reason to do that, then fees will rise. And that's why typically we've seen fees rise sort of around peaks in speculative activity. If there's a speculative jump in price, or if price jumps for any reason, fees tend to rise. In this case, we've actually seen price decline since this fee jump, and it's mainly been speculative activity on NFTs on Bitcoin. So you're not seeing that price benefit per se. And on the ordinal side of things, like I said, we're still seeing plenty of creations per day, I guess you could call them, or mints, inscriptions. Also sorts of funny words for making things out of thin air, but the point is we're still seeing these inscriptions made. We're just not seeing this high priority mania fever to get them minted to be first in line. So if there's another project or entity that wants to release this type of NFT where people want to own it and are willing to pay extremely high fees, we will see fees get pushed up once again. From a holder perspective, if we just look at the network in its entirety, we hit an interesting milestone this week with over 1 million addresses holding at least one Bitcoin. Now, these could be exchanges, obviously included in here. These could be one individual who holds 10 different addresses and has Bitcoin on it, right? But at the end of the day, this is a great temperature check for general interest and sentiment across the board. We're not seeing Bitcoin get concentrated into a few addresses per se, and we would see that on chain because if you look at the rich list of the top addresses, many of those are exchanges. But I don't think it's an accident that after these bank failures, we're seeing a jump in addresses holding BTC again. Just as with the exchange failures on the crypto side of things, we saw a massive jump in wallets holding Bitcoin because you're pulling your Bitcoin off of exchanges. And to me, I think self-custody promotes address diversification at the end of the day, which is why I think you're seeing a rise in addresses here. Another thing we can look at is when have the coins last moved? So we can look at the percentage of the supply that has last moved a year ago. And again, we're approaching another all-time high in dormancy for these coins at 68%. So 68% of the network hasn't even moved in the past year. As we see a rise in TradFi instruments and sort of financialization of Bitcoin, this metric gets a little less pure because anything related to futures or anything that you can trade but don't need to move the coins, essentially, you're going to get a false sense of elevated numbers here. But in any case, 68% of the network has not moved over the past year. And you'll notice this tends to dip. You tend to see holders stop holding, holders unhodling, holders selling, essentially, when you see massive appreciations in price. You saw it in 2011, 2013, 2018, right? You see it every time because everyone has a price at the end of the day where, if your savings 5x's or 10x's, as an individual, you have to make a decision. Do I want to continue saving or do I want to spend that, right? So you're definitely seeing that play out real time over the past 10 years. Flipping gears to ETH. ETH has a similar problem, I think, to regional banks. Not necessarily a bad thing here going on with ETH relative to regional banks, but as an ETH holder, you have an option. Do I want to put my ETH to work in DeFi directly, where there's, I would argue, considerable risk? Or do I want to just stake the ETH, hold it, and collect my 4.5%, or whatever it is? I think until the risk-adjusted return arguably is attractive, you're going to see ETH on-chain activity start to decline. You're also seeing other ways to transact ETH, layer 2s, bridges on the rise. So people are less reliant on ETH than they were previously. So this is really not a great signal anymore, I don't think, for ETH activity in general, because there are so many other ways to transact with ETH. But it's certainly not a great view that we're seeing continued declines in active addresses and transactions for ETH here. One thing we are seeing, though, is a rise in staking flows. These are ETH tokens that are sent into staking, effectively out of circulating supply. So the number that really out of this whole dashboard that's worth paying attention to is definitely the net flow. So we're seeing more sent to staking than pulled out of staking. And then something else that's interesting is the price and value where those ETH were staked. So right now, most of the money is about break even, around break even. And again, if I'm thinking about realized and unrealized profits, if I'm sitting on this waterfall profit in 5, 10x, right, I'm more likely to take profit on that than someone who's at break even. And as we approach the break even levels of the market in aggregate, you may see additional activity around unlocks for those coins. And I'll bet in the future, once we see, let's say a 2x from here, or a 3x, or a 4x from here, I think you're more likely to see unlocks occur at that time. At this point, ETH's been essentially flat for almost a year or more, and I think there's very little impetus for anybody to unlock. They'd rather just collect the staking reward at this point. And if we look at ETH being sent to validators, again, in a slightly different way, this is total now, over 21 million, almost 22 million. Now that the staking mechanism is liquid, many people don't even think twice about it. Whereas before, you sort of have to worry, when is it going to become liquid? Is it ever going to become liquid? Now you're totally fine. And there's actually a queue to stake your ETH to the tune of 2 weeks. So there are a lot of people throwing ETH at staking right now. And if we look at the breakdown, most of it is happening in Lido and Coinbase. As far as the top leaders there, I don't know what the unknown slice necessarily means, but I don't think it's trackable. So these could be individuals or some other service that just isn't on this list. The other thing that's important for ETH is the transaction fee burn mechanism, which to me is somewhat akin to a buyback mechanism. But they're burning ETH based on the transaction fees. So as the transaction fees rise, you're burning more Ethereum per day. So ETH, at the end of the day, ETH holders benefit from high fees because you're making ETH more and more deflationary. And if we break down the differences between ETH, if it stayed proof of work versus ETH proof of stake, you can see there's a pretty decent differential in supply over the course of the year. And then the orange here is Bitcoin at 1.7. This is set to decline by half in just under a year from now with the block reward halving. So my question is, at what point does this differential need to be at its most extreme to where you start to see ETH outperform in a big way relative to Bitcoin? Now, it may be more than just supply people are looking at, obviously, but just from a market dynamics perspective, if, let's say, half of the circulating supply is locked up in staking and you're seeing 10x the amount of ETH being burnt every day, that should have an effect on price. And we're pretty far away from that in the moment, but it's definitely something to watch in a bull market when there's more activity and people are even more likely to set their ETH aside and stake it. Switching gears to some TA in the final few minutes of the video here, I think across the board, the read here is quite clean. We've had 2 months of extremely wide ranging price chop up and down, and we've completed a head and shoulders chart pattern here with the head and then 2 shoulders on the side flanking it. This horizontal area is referred to as the neckline, and occasionally you do see, as we're seeing now, a throwback to the neckline. So it's definitely not bullish just because we've recovered 5-8% off the bottom. The direction remains fairly clear from a TA perspective that this in the near term is bearish. And if we look at where support stands, we can look at this pitchfork here. We can look at moving averages. This is the 200 EMA and the 200 MA, and gives you a fuzzy range of where this may go along with the measured move of this chart pattern. So I think 24 to 25 is reasonable. Doesn't need to happen quickly. And this whole setup gets negated if we start to break 30K again. So certainly not a slam dunk, but definitely leaning heavily on the bearish side of things and then just isolating the head and shoulders part of this. See what I mean here? Generally, we do see some sort of attempt right back at this neckline to breach this neckline, but in general, down is very likely the direction. On top of that, we've got a bearish TK cross on the cloud with the likelihood of a move through the cloud, which is referred to as an edge-to-edge move. Anytime you get an edge-to-edge move or trend reversal attempt, you typically have a pattern before that attempt, just as we did in January of this year. We saw an Adam and Eve double bottom. We're seeing, a trend reversal pattern. So there's plenty of TA evidence that this has confluence for a breakdown. You also have the cloud on your side telling you, look, if you're long here, this MA cross effectively is telling you to exit your long. So there's not a lot of TA evidence to be bullish here in the near term. And if we look at the 2.5-year hit rate of these edge-to-edge moves, there have been, let's say, 7 to 10 of them ish. And for the most part, they have a pretty decent hit rate. Now, the two that didn't work out nearly as expected were July and November last year. November was right before FTX blew up. And you could argue that this didn't actually reach its target because it didn't hit the other edge here. But in any event, these generally happen very infrequently, about once a quarter, if that. And when they do, they have a pretty good hit rate. That's why I pay attention. So I do like, again, the same levels, 23 to 25. I know it's a wide range, but depending on how this looks when it breaks down, it may get very angry or it may find some bidders and buyers in those regions. Lastly, just looking at ETH, again, not much has happened here. The staking mechanism being liquid is great. Moving to proof of stake made sense for ETH. That was the original vision for ETH, to start with proof of work for the distribution and move to proof of stake. But you have not really seen a bullish trajectory just yet from ETH following these changes in the protocol. So I'd argue you need, a higher percentage staked, you need more DeFi activity, you need NFT activity, you need people using the chain other than just staking, and this will come with time. But in the moment, this doesn't give me a lot of bullish immediate confidence here. And then just isolating the short term on ETH, the very same rationale applies here. Bearish TK cross above cloud, ugly looking head and shoulders, and the potential for an edge-to-edge move. So for ETH, I think sub 1650 is reasonable. But again, it's very hard to be bullish here in the near term on either of these. So that's all I have for this one today. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.